This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. Now, in conversation with James Bullard, the former St. Louis Fed President, are Michael McKee.
Well, thank you all very much, and we'd like to thank Jim Bullard for coming in and joining us today. I would have called you Mr. President, but now, why do we call you Dean Bullard, I guess?
You can call me Jim.
Well, Jim is the Dean of the Daniels School of Business now at Purdue University, and we thank you for joining us today. I want to start with the dot plot. I think we have a picture of the dot plot that we can put up. For those of you on radio, you can look up the dot plot on the Fed's website. But basically, in June, the last time we put out a forecast, there was one lonely dot way at the top saying 6.25%. You left. That dot's gone. How would you have voted if you were there yesterday?
I thought this was a pretty good decision on the part of the Fed here. The higher for longer message, I think, is consistent with the rhetoric we've been hearing from the committee. Earlier this year, there was widespread prediction that there would be a recession, and in the second half of 2023, that recession isn't materializing. So to the extent you thought that a recession would produce extra downward pressure on inflation, that had to be taken back out. So you ended up with a higher for longer message here. I think that makes a lot of sense.
So we don't need higher rates at this point?
Well, the committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down at an appropriate pace so that the committee can get back to 2% inflation in a reasonable time frame. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy. So you have to take account of that probability when you're making policy. I think the committee has done that here.
Well, one of the interesting questions is about the forecast. John was just talking about it. You've got the Fed saying their growth forecast has doubled, their unemployment forecast has been cut significantly, and yet they're also predicting that PCE core inflation is going to go down. How does that work?
Well, I think you will get disinflation with, that's the base case. The question is, how fast will that disinflation occur? If it's a very slow disinflation, you're going to want to keep policy rate higher in order to put more pressure on so you get back to 2% sooner. And there's a little bit of probability that inflation would just stall out completely at the current levels, which would be unacceptable. It's, core inflation has a handle, depending on how you measure it, in the 4 range is still double or more than double the Fed's target. So you've got a long ways to go here. And I think you want insurance on the side of making sure that you get back to 2% inflation. On the real side of the economy, things look pretty good. You've got some reacceleration in the third quarter here. It looks like we've talked about it before, and unemployment still with a 3 handle looking very good.
Jay Powell wouldn't say the words, but it looks like the forecast is saying soft landing.
Yeah, I think the prospects for a soft landing are very good, but you haven't landed until you get inflation back to 2%. So you're only partway through this process, but prospects are looking good.
If that's the case, then the question becomes higher for longer. How much longer? The Fed took away 50 basis points of cuts from their forecast for next year. But how long do you think you need to lean against inflation to have an effect?
Well, there'll be data dependent on that, but I think this idea that you'd have 5% policy rate or higher over the next 18 months or so, I think that's significant and shows you resolve on the part of Chair Powell and the rest of the committee to get inflation lower. So that's quite a while. I think once you get out beyond that, the end of 2024, you get into 2025, nobody knows at this point.
Well, that raises the question of lags and how long the lags might be if it takes 18 months to bring it down.
Yeah, I don't know. I haven't liked the long and variable lags story for the modern era as much. I think a lot of the transmission of monetary policy occurs pretty rapidly through financial markets in a way that was not the case in the 1960s and 50s, that when Friedman was talking about long and variable lags. So I think the economy has changed. Information moves much faster. Decisions are made much faster than they would have been. And the world's more forward-looking than they would have been in the 60s and 50s. So I think you should look for impact today, or more impact today than you would have in that earlier era. And so by keeping the policy rate high right now, I think you can get disinflation to happen now. It's not really so much 2 years from now. Well,
what kind of economy will we have 2 years from now? We get the pandemic distortions in the economy out, supply and demand maybe come back into better balance, but do we have a new economy? Do we have an old economy? Where do you think neutral is? Are we going back into a rate regime that is higher than we were used to in the 2000s?
Yeah, I think, and we've talked about it before, but one of the historical examples that you want to look at here is the 1994 tightening cycle, which was not as big as this one, but set up the U.S. economy for a stellar second half of the 1990s, one of the best periods in U.S. macroeconomic history. So if you can get inflation to continue to come down here with a pretty strong economy, you could set the economy up for a productivity boom and a very strong period in the 2020s here. So hopefully that's what will happen. I think we're only partway through that process at this point. But if you really do get a soft landing, then you could look at a period of good growth, strong labor markets, high productivity growth. So I'm not saying that, that's definitely going to happen, but that's certainly one of the possibilities.
What happens, we'll have only about one question left here, but what happens with the labor market going forward? Are we going to see ongoing wage pressures because there just aren't enough people to fill the jobs out there?
Yeah, I think the labor supply is somewhat diminished from where it would have been pre-pandemic or earlier. I think you have older workers less willing to come back into the workforce, so they're kind of a marginal worker type, and they're not coming in as much. Their nest eggs are pretty robust here with high housing prices and relatively high equity prices. So I also think daycare has been kind of decimated by the pandemic. So this has changed arrangements for parents with young children. And so you just have a subdued labor supply compared to what you would have had pre-pandemic. And this is leading to continued tightness in the labor market.
Well, we thank you for coming in. We're going to send you back now to Purdue to graduate some more engineers so we can fill those empty labor slots. Jim Bullard, thank you for joining us today. We'll send it back to you in London.
Hey, Mike, can you just squeeze one extra question in? Can you ask Jim, if there's no value in the forecast, why are they still producing them after that performance from Chairman Powell yesterday? Can you ask him quickly, Mike?
Sure. John is asking, if there's no value in the forecast, then why do they keep producing them?
Well, it's what we do. I think, forecasts are useful, but only up to a point. There's a certain amount of ambient noise in the economy. You can't get away from that. But so you can't live with them and you can't live without them. I guess is the way you would say that.
All right. Thank you very much, John. I hope that answers your question.
Thanks, Mike. Just about. Mike, appreciate it, buddy. Fantastic work. Just one of the best, as always. And brilliant performance in the news conference from Mike McKee yesterday as well. Sitting down with the former St. Louis Fed President, Jim Bullard.
With Abrdn, Sree Kochugovindan joins us this morning, their Senior Research economist. The growth issue there is just absolutely tangible and germane to a shop like Aberdeen as well. Are you calling for a recession when you see the split of that, the tension of a 5-4 decision?
I think that's right. We are looking for a recession later this year, actually, and one that continues well into next year, possibly the first 2 quarters as well. Now, if we look at the data that we've seen recently, obviously there can be some revisions in the GDP data. We saw quite a contraction in July. Now, we are expecting, perhaps there are some quirks in the data that we haven't seen as much industrial action recently, and there could be some technical issues and a rebound. But I think the outlook for the rest of this year is quite weak. And we see that, as you've mentioned, in the PMI surveys, both manufacturing and services moving into contraction.
Well, let's talk about the market response. You are seeing a weaker pound in response to this, as many people expected it would. At what point are they between a rock and a hard place at the Bank of England? If they don't hike, the pound weakens, it increases inflation, even as growth slows. How much is this going to be a real consideration for them going forward?
I think obviously imported prices are going to be a consideration, but what we saw earlier yesterday in terms of the inflation data was very promising. And I think one of the key metrics that they focus on, what really changed, was that core services data. We saw a deceleration there as well. But I think it's still very elevated. We are still seeing another key metric of wages are still very high, and hence this signaling through the split and the announcement of QT. Something that we've been expecting for a while is that they will increase the pace, the run rate, but they've done that today, and I think that's an interesting communication issue.
Well, what is the signal, right, from the split, other than they're just divided? It is a difficult moment. What is the signal that you can take away as an economist coming up with your own projections?
I think really what we're seeing is they are worried about the recession. They are worried about weaker growth, and they think that perhaps going into the rest of this year, inflation is likely to continue to decelerate. So what we're seeing is the lagged impact of fairly aggressive monetary tightening really starting to bite. And they're probably thinking, right, that here is a time to pause, but we don't want to get too complacent. There are still a lot of inflationary pressures ahead, and there's a long way to go before we go anywhere near target.
Sree, help us understand the bond market move in the gilt market right now. 10-year gilt yields are higher on the session, near session highs, up about 7 basis points. Does that stack up for you?
I think it's a knee-jerk reaction, perhaps. There is the hawkish signal there is really being the focus, I think. But what we will say is, even though we are very close to the peak, we do expect rates to remain elevated, and we're thinking more Matterhorn more Table Mountain than Matterhorn, really. So really on hold, elevated for a long period of time, well into next year.
Could I offer an explanation? Do you think to some extent this might be a Bank of England that's starting to become more concerned about growth over inflation, and a bond market starting to pick up on the scent of that? I
think there is a shift. It was a very, very close call, and I think that inflation number really sort of tipped this decision. There are some other disinflationary pressures with, food prices are likely to continue to drag down inflation to year end. But as you say, we're still nowhere near target, and I think that the growth priority is starting to pick up.
Back to your work at Queen Mary in London, do you find it more beneficial to have a highly visible, dissenting, nuanced, split vote like at the Bank of England, or are you more able to make theory and forward-looking views over the "we are the world, we're all in it together" view of the Fed?
I think the split is part of the signaling. I think that's actually quite a useful signal, and you can see that in the bond markets. They're taking this as a hawkish pause, and that's actually what is necessary in a sense in order to continue on this path of disinflation. Unfortunately, we need a recession to really correct some of those imbalances that are quite particular to the UK economy.
No change isn't boring, TK, in London. No change is not boring. 5-4 split.
I'm fascinated by it, and to know the heritage of Catherine Mann at MIT and Megan Green at Oxford, and these are huge decisions, folks. This is not a small matter, and I go back to the real yield. I know Kit Juckes is all over that in his morning note as well.
Sree, thank you. Sree Kochugovindan of Aberdn.
An expert on Saudi Arabia, Edward Morse holds court at Citigroup, global head of commodity research, and always takes a geopolitical look. He has been brilliant over the last 2 years of saying, everyone calm down. We're going to see lower oil prices, more sustained $70, $80 prices, and then things have changed. At Morse, what changed to elevate oil to $100 a barrel?
Well, it's quite simple. A bunch of countries that had a lot of surplus capacity decided to rein it in and pull back. If you look at the oil market, there's no more oversupplied market in the world based on supply and demand. But those that have the supply have pulled it back, and they pulled it back because they didn't like the revenue that they were getting. So there's a big difference between oil and copper and oil and a lot of other commodities in terms of the fundamental availability of supply in that market.
Right. We were making fun and jest of the orb, and that is, of course, President Trump visiting Saudi Arabia. What is the U.S. relationship now with oil-producing Saudi Arabia? Has it changed?
Yes, it certainly has changed, and it's changed dramatically. Part of the change relates to the geopolitics of the area. We saw one element of the change at the G20 meeting when a number of countries that include India, include countries in the Middle East, including Israel, include the European Union, decided to build physical, their own Belt and Road Initiative. And they excluded China and they excluded Russia from it. But the U.S. is very much a part of it. We're talking about Westinghouse technology going into Saudi nuclear power. We're talking about guarantee on the security side. We're talking about oil markets and common and differences among them. But it is a different relationship from the more sour one with which the Biden administration began itself in office.
Ed, earlier in the year, you were the lone caller for some sort of lower oil pricing. You were absolutely correct. Now you're coming out and pushing against people who are really upgrading their forecasts for oil in light of some of the Saudi Arabian production cuts. How can you be so sure this time around if this is essentially Saudi Arabia searching for $90 to $100 a barrel of oil for their financial well-being?
Sure. Well, I think there are 3 or 4 factors that just overwhelm it. One of them happens to be what we call the fragile 5 countries. They are Iran, Iraq, Libya, Nigeria. Nigeria and Venezuela, they're countries that in 1998 were growing really rapidly in their production. People thought they were going to be adding 1 million barrels a day a year. 5 years after 1998, they were producing less than they were in 98. The world scrambled to find new supply and the price of oil went up. These countries are adding supply in surprising ways. If you look at June versus June, 2023 versus 2022, these countries added over 1 million barrels a day to oil supply. If you look at where they are now and just look at Iran and Iraq, the chances are that the 2 of them together are going to be adding close to 1 billion barrels a day of production between now and a year from now. That big change. And the change is not just among the 2 of them. If you look at Nigeria since the recent elections, they went from the monthly average of 1 to 1.2 million barrels a day to now 1.5 to 1.7 million barrels a day. They're at 1.7 right now. So those fragile 5 countries are not under the control of the leadership of OPEC Plus, and they intend to put more oil in the market. A second really massive factor is China. China has, yes, an economy that is more commodity dependent than any other country in the world. But what China has done since the great financial crisis and done it consistently is buy low and sell high. So they accumulate an incredible amount of inventory. The inventory that they've grown has been from just under 1 billion barrels at the beginning of the pandemic, not very long ago, to 1.4 billion barrels in our judgment right now, with a capacity to go to 2 billion barrels. 1.4 billion means they have 130 or 140 days of forward supply in their inventory system. The IEA, in its wisdom, says 90 days of forward supply is ample. So they're in a position to do what they're now doing, buying less oil in the market. They had 4 months in which they were buying 12.5 million barrels a day. They have 4.5 million of their own production. They had months in which they had 17 million of supply. They don't refine more than 14.8, 14.9. They put it in inventory. And now that prices are very high, what are they doing? They're selling, and they're selling incrementally an awful lot of diesel into a market which is diesel, poor, and where diesel cracks are overwhelming. So they're making money by not buying and by selling high on the product side. And then we still have ample production growth from non-OPEC. Our judgment is that demand is going to be slow because of all the macroeconomic trends you guys have been talking about for the last 15 minutes. We don't think demand is going to be growing, more than 1.2 million maybe barrels a day next year. And non-OPEC alone can fill that without even thinking about the Fragile Five or what China is doing. So I think, the way we look at the trends, it's going to be a weaker market.
Just quickly here, Ed, in the interest of time, what you basically said is that China is building its own SPR that's much bigger than the U.S. as the U.S. was trading their own SPR. How much is Saudi Arabia going to keep production low simply because they know China is not going to be a big buyer?
I don't know. I don't know how to read the tea leaves on it. There was an article in Arab News involving a conversation between the Crown Prince and the Prime Minister of India at the G20 meeting. And the Crown Prince is quoted in a Saudi newspaper, therefore it's intentional, that if oil sustains above a certain level, they'll be putting more oil back in the market, or there are good chances of it. That was not an accidental story. So we don't know what the pressure point is. They like 90. They don't like 80 or 70 as much as they like 90. And they're fearful of what happens at 100.
Ed, thank you, sir, for the update off the desk over at Citi. Ed Morse there, not as bullish as some.
Right now, the interview of the day. This is a scheduled 6-7 minute interview. It ought to be 2 hours. Juckes joins us, chief foreign exchange strategist at Societe Generale, and he led his research note today with what I was looking at early this morning, and that is the change up there. And the change is a U.S. real yield back to where it was in late winter of 2008. Kit, things are moving. Where are we going to be a month from now? Where are we going to be 3 months from now?
Left to itself, and I think in 3 months' time we're going to have potentially still higher real yields in the U.S. keeping on this going. It's going to stop at some point. I mean, part of the discussion is the political one, right? The big difference between the United States and Europe is that we're all raising rates because we have an inflation problem, but we have to tighten fiscal policy. John just said it. We can't spend this money. We spent so much money on COVID, a war in Ukraine. We have no money, and so we're in a difficult place. The United States can spend money because it's the United States, unless the politics says it can't. So as long as the politics lets the US be exceptional, you can have higher yields and a stronger dollar as far as it goes.
What we've seen in the last 48 hours, and as John mentions, Bank of Japan has a hat trick tomorrow. Do we see, with what's moving, yen go through 148, 149, weaker yen, where all of a sudden the Bank of Japan is overcome by Powell and Bailey events?
They have to do something extraordinary at the Bank of Japan to stand in the way of this tide of rising yields in the U.S. So they'll have to raise rates or intervene. Jawboning is not going to get us much further than we are today.
So no change at the Federal Reserve, no change at the Bank of England. Are we expecting any changes from the BOJ? Not tomorrow, but this year?
He hinted at them. I heard someone else on the Bank of Japan board sort of row that back a little bit and saying he was talking to the foreign exchange market. They can't just talk to the foreign exchange market. They have to decide what they want to do with monetary policy, and it's a tough decision given their challenge. But this is so like a baby 1984, 85. I mean, it's sort of, somewhere in there. If you can imagine,
for those who were babies in the mid 80s, Kit, can you explain what a baby 1984, 85 is?
I don't want to say that Jay Powell is Paul Volcker, and I don't want to say that Joe Biden is Ronald Reagan, but it's this ability to push the dollar higher than you could imagine. I was in my first job. Everything I thought about fair value for currencies, anything I'd learned in school, was blown out of the water before we got to Plaza. This can, trying to guess how far you can go at the sort of the pointy end of this piece of the cycle is really crazy.
So we don't know how far you can go, but we do know that some people are expecting, including JP Morgan's chief equity strategist over in Japan, they expect that the Bank of Japan will leave yield curve control next year, end negative rates, possibly by even later this year, if not early next year. Do we have an understanding of what the knock-on effects would be, not just from a currency perspective, but from a rate regime globally?
I think generally, they're so far behind everybody else that it's possible that it doesn't completely rock all the boats in the world. Right? This is a country where what that would do would start the process of Japanese investors buying JGBs again at higher yields instead of buying foreign assets. So it has a knock-on effect in the currency market, but they're not as big or as important as a player on a flow basis as they were 30 years ago. So it doesn't necessarily have to start a new, long, dramatic rise in global bond yields. But it causes waves because it tightens global monetary policy one step beyond what we've been seeing. And if you forced the Chinese to follow at some point, if they don't want the yuan to weaken, you can take this further. So it all rolls it down.
You know, we're talking about a stronger dollar and how far that can go at a time where, as you were saying, the U.S. can be exceptional as long as lawmakers allow it to be so. How far can it go before it becomes substantially problematic for the rest of the world, in particular the UK, in particular Europe?
I think it's already problematic. I mean, you already see the Chinese who usually have complete control over things like their currency don't like the yuan weakness. The Japanese don't like it there. If you send U.S. yields higher and the dollar stronger, you could reverse some of the wonderful progress that's been made in Latin America in the last few years. So we're not far away from people howling about what this is doing. I mean, this is the problem. A stronger dollar will be much less damaging to the United States in the short term than it is to other people.
To me, what's really important here is the analysis of a difference between Section 14 at Emirates versus Section 60. I mean, do you really need the elevation to see the Spurs on, was it Saturday or Sunday, John? Do you need
Sunday,
the elevation of a Section 60, or should you go lower at Section 14?
It's a bit noisier downstairs, but I like to be able to see both ends of the pitch at the same time. I like to look diagonally across the pitch so that I can see everything.
This is when
happen.
the Spurs beat Arsenal.
Then I'm very glad I've hidden away up in the nice seats.
Kit and I have watched the North London derby together many years ago. I think maybe 9 years ago, something like that, maybe 10 years ago. It was a good time. I think Arsenal absolutely crushed Tottenham back then. I think Theo Walcott was there.
He was still there.
Yeah.
Harry Kane was there as well.
Was he there?
How come Arsenal has U.S. ownership that's successful and other selected teams do not?
Kit, do you want to explain that? When you say selected teams, are you saying Chelsea?
I'm going to go with it took a while for them to get good at it, but that they have a heritage and a history in owning football clubs in that family.
Yeah, and the Los Angeles Rams or whatever the Rams are.
We're talking about here,
What about the Saudi money? I mean, the petrodollar money coming in. Is that going to change Arsenal and the rest of the sport?
It changes all sports everywhere to have Saudi money coming in until the thing levels itself out. And so the problem with sport, I mean, in that sense, there's an enormous amount of money that changes it for the average fan, recognizes the fact that the economics of sport has changed, which we could talk about for a whole day, and does a bunch of things to, in the short term, to the politicization of sport, which again, is an interesting sort of thing. But at Arsenal, frankly, the change of manager was possibly the big change we made.
Yeah, Mikel Arteta. As we mentioned, the Tottenham chairman, Daniel Levy, revealing he'd be open to selling a stake in the club, quote, for the right person. I sat down with Levy for a wide-ranging interview on the club, including the recent sale of star Harry Kane to Bayern Munich. Take a listen.
So Harry was willing to stay, but he wasn't willing this summer to sign a new contract. He didn't say that to me that he wants to leave. He didn't say that he would never sign a new contract. But he wouldn't commit this summer. And of course, we were in a very difficult position. Had 1 year on his contract. And as a club, as I said, we're self-sufficient. We couldn't live in a dream that he would sign a contract. We had no guarantee. And therefore, when Bayern Munich came along, he was willing to go to Bayern Munich and we agreed a deal.
You've since disclosed there is a buyback clause. That's getting a lot of attention and a lot of fans excited. Can we talk about the terms of that buyback clause? What is it?
If I'm honest, I think the actual precise detail of the contract with Bayern Munich should remain confidential. All I would say is if Harry one day wants to come back to the Premier League and he wants to come to Tottenham, we would have the ability to purchase him.
We've talked a lot about Saudi Arabia and the disruption in this summer transfer window, not just for English football, but for the whole of European football. Are you getting players knocking the door now saying, I've seen Neymar's contract in the newspaper and I want a slice of that? Has this changed things for you?
I think you have to look at the Saudi Arabia situation as, it gave a huge influx of money into the market. The market is particularly tough outside of the UK at the moment. And I don't see that what's happening in Saudi Arabia is going to have any direct bearing in terms of player contracts in Europe.
What do you expect it will change?
Well, it's another market for players to look to. Not every player will want to go to Saudi Arabia, but just as not every player wants to go to Germany or France or wherever.
Joe Lewis has got his own legal problems. He's transferred his holding of the football club to family trust. We understand that dynamic and how things have changed in the last couple of years on that front. Technically, that means you no longer have that big billionaire backer. Do you need one to succeed? Is that something that Tottenham needs?
Well, firstly, the ownership of Tottenham has been of no relevance to the operations of Tottenham for the last 20 plus years. It's always been self-sufficient. As far as very wealthy people owning football clubs, as I said, the new rules now are going to be engineered to such an extent that hopefully you don't need to be a very wealthy owner in order to have a successful club.
Would you be open to selling a stake?
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Has anyone made an offer?
Over the years, many people have made offers, but there's never been an offer that's been...
Well, give us an idea of what those offers have looked like. Where have they come from?
All parts of the world. The Far East, the Middle East, America. But nothing has been put on our table that we felt has been in the interest of shareholders.
The stadium's been a big project for you, and clearly that's right for the club, and other people are starting to copy you as well. How big of an initiative has that been for Tottenham Football Club, and how do you think it's going to really underpin the success in not just years to come, but potentially decades?
I think people don't realise how big a project building a stadium is. That project took us probably about 17, 18 years from start to finish. I think you've got to take a very, very long-term view. I think that it obviously has a major impact on the club, positive and negative, because you don't build a stadium for nothing.
A multi-purpose stadium as well. It's not just about football anymore, is it? It's music, concerts. It's about everything else and all above.
Well, that was done for two reasons. One is, when you look at the cost of building a stadium, you're talking about such huge sums of money. In our case, it was £1.25 billion. I think today it would be over £2 billion.
Wow.
And you have to find ways of paying for that asset. And just having football games is not enough of income to generate.
What does music bring in, Daniel? Give me an idea of what a Taylor Swift, Beyonce music concert brings in for Tottenham. How much money can you make from something like that?
Well, every concert's different. So it's not just concerts, it's boxing, rugby, all sorts of events. You're not going to justify spending the money by all those other events. What they do, though, they make a contribution to the capital cost. I would say that over a full year, we may make 20, 30 million pounds of additional revenue as a result of it.
And what's the gate receipts look like just in terms of football over a season? How does that compare? How does that stack up?
Well, our gate receipts now are over £100 million.
Big Ange has come after Antonio Conte and Jose Mourinho. Can we talk about dealing with difficult characters? What was it like dealing with Antonio Conte near the end?
I had a good relationship with both Jose and Antonio. They're different, and as I said to my fan forum last night, I said to them, I made a mistake. They are great managers. They were just not right for this club. And the way they want to win is different, really, for how we need to win.
What does that mean? They're proven winners. They've won before. What does that mean?
I think there's a couple of things. I think our style of football that our fans crave for is we want attacking football. And if that means winning 4-3, then so be it. Whereas I think their style of football is, they don't mind being defensive and winning 1-0. And we were in a situation where we were so desperate to win. I think at that moment in time, when I go back, 4 or 5 years ago, I think we would have taken any way of winning. But we didn't win. And therefore, when you don't win, you get a very disgruntled fan base with our fans.
Where did the pressure come from to begin with to hire names like that? I was listening to the recent fan forum you did, and you mentioned that certain players wanted a certain kind of manager. You alluded to that. I'm paraphrasing to some extent. Were there certain players that wanted that kind of name? Jose Mourinho and Antonio Conte? Do they come and knock the door and ask for that?
And it wasn't about the name. It was about they wanted to win, just as much as I did. And then we'd come so close with Maurizio, who was a great manager, and he did fantastic things for this football club. And we got frustrated, and I think we went through a phase where we said, well, let's try something different, and it didn't work.
Define success for this season. Let's finish there. What is success for you this year?
That's a difficult one for me to answer, because I think I'd be putting unfair pressure on my new coach. Honestly, I think for us, though, we want to play football where we're entertained. We want to come to a game where we're looking forward to coming to a game, where we believe we have a really good chance of winning. We just want to entertain our fans.
Entertain and win?
Of course win, but win with style.
Daniel Levy, the Tottenham chairman, will put out the full conversation over the next week or so, but a pretty extensive conversation with the longest-serving chairman of a Premier League football club.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.